What's up everybody, Tony from Good Story here with your November 2025 market update. Literal ton to unpack in this one. We've got market numbers, we've got a Bank of Canada interest rate announcement, and we've got the federal budget all coming down the pipe in the same week. First off, Bank of Canada, they've lowered the overnight interest rate by another 25 basis points to 2.25%. What does that mean for you as buyers or sellers? Funny enough, I had a client ask me today, a first-time home buyer, saying, what does that mean for me getting into the market? Can I expect more competition? Is this going to create a big wave of buyers coming back? And I actually said no. I said, I don't think that's going to be the case at all. I think the Bank of Canada has lowered the interest rate because the economic outlook for the short and potentially long term based on the tariff and trade war with the US has kind of created a bleak outlook for us. So I think the Bank of Canada is lowering the interest rate in order to drive the economy and try to help out in any way possible. I don't think that's creating a ton of buyer sentiment to say like, hey, now is the best time to go. I think people are really watching their every dollar, they're budgeting, they're gonna make moves when the time is right, but it's not creating any sense of urgency or panic to say, I gotta move now. Then on the other side of that, for sellers, you can expect a lot of the same thing. I am a broken record, I own that, but you know, as I always say, if it's priced well and it shows well, it will sell. And that's the exact same mantra that we're going with in this month too. If buyers are protecting their dollars, if they're investing wisely, then you need to be that investment that makes sense for them. Meaning your home has to show its best. You need to be priced sharply. You cannot be overpriced because people will simply scroll on by. So on the federal side of things, the budget was released this week. And I guess, you know, the best way to sum it up is spend less and invest more. We're seeing a lot of investment in housing industry. We're seeing big capital for housing and infrastructure. We had the Build Canada Homes program coming down the pipe, hopefully creating more inventory for our market. You know, supply and demand has been something that we've preached this entire year. The demand is there, we just don't have the inventory to support the population, and that's why pricing remains so high, even in a balanced market, which I really believe this whole year has been. We haven't seen crazy jumps in housing prices because the demand and the supply just don't equal one another. In this budget, we've also seen a complete elimination of GST on new homes for first-time home buyers when it comes to new home construction. This always seems to be the case. If you've been following any of the budgets released over the last 10 years, the builders always get the break first. It's very rare to see that type of injection of hope, I'll call it, into the resale side of things. But I do think, you know, anyone getting into the market, new homes are always very desirable. It still is the case nowadays. It's certainly a lot slower than it was, especially during the pandemic. But that demand is still there, and this just helps people get into that either starter price point, whether that's, you know, a condo or in our case in Ottawa, mostly like townhomes, that type of thing. But I want to talk about the elephant in the room as well. I'm sure that anyone who's been following the news at all this week has learned that the federal government also plans to cut public sector jobs by about 40,000 by 2029. Certainly in Ottawa, as the federal government is our #1 highest employer, we're going to feel some of the ripple effects from that. Now, it doesn't mean immediate cuts, like people will be fired and 40,000 people will be fired. That's not what they're saying. This is going to come from early retirement incentives, other types of, you know, shuffling people around in order to put demand where it is, and then maybe eliminate some of the current positions with AI, that type of thing, to really streamline operations there. I don't want to ruffle anybody's feathers. I do think it's necessary. I think the majority of people would agree with me on this. That's a hot take given the city we live in, but I think long term, the increase to the public sector that we've seen on the federal side of things wasn't sustainable, and our GDP and economic outlooks aren't supporting that either. So it's inevitable that it was going to happen. If you look back at previous governments, this is actually not as bad as, say, like the Martin government was before us. Let's hope that by 2029 we have a better outlook and maybe some of those jobs can be saved. At the end of the day, it does mean fewer private sector paychecks in our local market, and it's definitely something that we have to monitor and keep an eye on as we, you know, get into 2026 and 2027. But here at home, the numbers, what does it all mean? Well, I'll tell you right now, it's been a lot of the same. Just quickly, detached, it's up about 1.7%. It's sitting at about 767,000. That's the median price for all detached across Ottawa. Detached is slowed a little bit. I mean, to see any kind of growth year over year, I think is positive. It's been very challenging for people to level up from that townhome to that detached home this year. And I expect a lot of the same in 2026. So if that delta remains high between the detached and the townhome stuff, anyone living in a townhome is going to have a hard time making that jump to the detached. And that being said, detached, although we saw some really good year-over-year gains last month, if you look at the numbers this month year-over-year, it's pretty flat. It's still at about 570,000 median. I do think we're going to hover around there. Maybe it goes up a little bit by this time next year, but I don't think we're going to see any kind of crazy jumps. If it was me and I'm focusing long-term, I'm working on my mortgage pay down, maybe I'm making lump sum payments to give myself a little bit of breathing room in order to make that jump, because if you're just banking on strictly equity gains, I'm not going to be so negative about this, but I just don't see the path to seeing like very liberal 7 to 8% gains like we've been seeing in the last 10 years. Condos. Well, you know, last month, I believe we were down a little bit year over year. We've kind of brought that back up. I'm telling you right now, condos, it's all doom and gloom in Vancouver and Toronto, but for whatever reason, Ottawa has been relatively insulated. It kind of depends on where you're at. Like if you're in the market trying to sell something, it's definitely gonna be a lot more challenging than if you're in Westboro trying to sell a condo. But we're still at about 395,000 median. And like year over year, like I've been monitoring this for the last 2 years, and it's hovered right around there. So really impressive stuff considering that the Toronto and Vancouver markets are hemorrhaging money. So bottom line, steady pricing, better borrowing conditions, and a budget that backs housing. But with public sector job cuts, it's a bit of a wild card in the situation. I think we could see subtle ripple effects of affordability in our market here in Ottawa. Now that being said, bigger picture, I think 2026 and into December, it's gonna be a lot of the same. We're gonna be in a balanced market. Homes are gonna sell, people are gonna move. As long as you have a strategy in place, as long as you are aware of what incentives are available to you as buyers, you guys can make really smart decisions and move with confidence that you're making the right decision, even in uncertain economic times. All that said, reach out to myself, reach out to one of the team members here at Good Story. We'll walk you through it, buyer, seller, whatever the case, and we'll do one more to ring out 2025 next month, December numbers. We'll see you then. Cheers.